In the realm of finance, foreseeing shifts in economic landscapes is paramount. Billionaire investor Howard Marks, co-chairman of Oaktree Capital Management, recently sounded an alarm bell that resonated across the financial world. Marks delivered a stark warning, suggesting that the era of easy money, which has characterized the global economy for decades, is likely drawing to a close. This shift, propelled by the ascent of interest rates, is poised to send ripples through both the economy and financial markets, heralding a new era fraught with challenges and opportunities. Marks' admonition comes at a critical juncture, as the global financial ecosystem braces for a paradigm shift. Over the past 14 years, the global economy has luxuriated in an exceptionally favorable environment, with historically low interest rates fueling economic expansion. However, a sudden surge in inflation during 2021-2022 disrupted this idyllic tranquility, prompting the Federal Reserve to abandon its near-zero interest rate policy in favor of an aggressive rate hiking campaign. While ostensibly temporary, Marks contends that these rate hikes will persist at levels higher than the historic lows witnessed in recent memory, marking a significant departure from the decades-long trend of declining rates. Understanding the implications of this transition is paramount, as investors navigate the evolving landscape, re-evaluating their portfolios and strategies to thrive in this new era of heightened economic uncertainty. Over the past 14 years, the global economy experienced what many deemed a golden age of low rates. This era was characterized by historically low interest rates, which acted as a catalyst for economic prosperity. The accessibility of cheap borrowing not only spurred economic expansion but also emboldened companies to pursue ambitious growth strategies. Consequently, this period witnessed the emergence of a protracted bull market, with businesses thriving and bankruptcies remaining at a minimum. However, as the economic landscape evolves, it becomes increasingly evident that this era of abundance is reaching its denouement, signaling a shift towards a more uncertain and challenging environment. The backdrop of historically low interest rates has been instrumental in shaping the trajectory of the global economy over the past decade and a half. With borrowing costs at unprecedented lows, businesses enjoyed unparalleled access to capital, fostering an environment conducive to growth and innovation. This favorable climate fueled a prolonged bull market, characterized by soaring stock prices and robust corporate earnings. Yet, beneath the veneer of prosperity, cracks began to emerge as signs of inflationary pressures surfaced, signaling the imminent end of this era of easy money. As central banks pivot towards tightening monetary policy in response to rising inflation, the curtain falls on the golden age of low rates, paving the way for a new economic paradigm fraught with challenges and uncertainties. The serene economic landscape of the past was abruptly jolted by an unexpected surge in inflation during the years 2021-2022. This unforeseen uptick in inflationary pressures disrupted the idyllic tranquility that had characterized the preceding era. In response to this inflationary shock, the Federal Reserve, as the central banking authority of the United States, swiftly recalibrated its monetary policy stance. Abandoning its erstwhile near-zero interest rate policy, the Fed embarked on a decisive pivot, initiating an assertive campaign of rate hikes aimed at reining in inflationary pressures and restoring economic equilibrium. However, what was initially perceived as a temporary measure to quell inflationary concerns is now viewed by Howard Marks and other astute observers as indicative of a broader and more enduring shift. Marks contends that these rate increases are likely to persist at levels higher than the historic lows witnessed in recent memory, marking a significant departure from the decades-long trend of ever-diminishing interest rates. The ramifications of this seismic shift in monetary policy are profound and far-reaching, reverberating across the economic and financial landscape. For years, investors and businesses alike had grown accustomed to the era of easy money, characterized by persistently low borrowing costs and abundant liquidity. However, with the Federal Reserve now poised to maintain higher interest rates for the foreseeable future, the dynamics of the global economy and financial markets are undergoing a fundamental recalibration. This departure from the prolonged trend of declining interest rates has significant implications for asset valuation, investment strategies, and overall economic performance. As investors grapple with the implications of this new paradigm, navigating the evolving terrain of monetary policy and its repercussions will be paramount in charting a course toward sustainable growth and prosperity in the years ahead. Understanding the intricate interplay between interest rates and asset valuation lies at the heart of comprehending Howard Marks' cautionary message. The value of any asset, whether it be stocks, bonds, or real estate, hinges upon the anticipated future cash flows it is expected to generate, discounted back to the present using an interest rate as a yardstick. When interest rates decline, the discounted value of future cash flows swells, propelling asset prices to new heights. This phenomenon has been the driving force behind the upward trajectory of markets over the past 4 decades, fostering an environment of prosperity and wealth accumulation. However, as interest rates begin to climb, future cash flows face a higher discount rate, resulting in a reduction in the present value of assets. This inverse relationship between interest rates and asset valuation underscores the intricate dance between monetary policy and market dynamics, shaping investment decisions and portfolio strategies in an ever-evolving financial landscape. The implications of this dynamic relationship extend far beyond mere fluctuations in asset prices, permeating virtually every facet of the economy and financial markets. As interest rates rise, the attractiveness of alternative investment options relative to stocks diminishes, prompting investors to reassess their portfolio allocations and risk profiles. Moreover, sectors traditionally sensitive to interest rate movements, such as real estate and utilities, may experience heightened volatility as market participants adjust to the new paradigm. In this environment, astute investors must remain vigilant, carefully evaluating the impact of shifting interest rate dynamics on asset valuations and positioning themselves to capitalize on emerging opportunities while mitigating potential risks. By cultivating a deep understanding of the intricate interplay between interest rates and asset valuation, investors can navigate the complexities of today's market environment with confidence and resilience. The implications of the forthcoming transition away from the era of easy money are wide-ranging and complex. Elevated interest rates pose significant challenges for the stock market, as they diminish the appeal of stocks compared to alternative investment options. With borrowing costs on the rise, corporations may face squeezed profit margins and subdued growth prospects, prompting investors to reconsider their exposure to equities. Meanwhile, the shifting landscape presents compelling opportunities in the realm of bonds, particularly for investors seeking refuge in safer havens. Government and corporate bonds now offer yields that rival the historical average returns of the stock market, enticing investors with the promise of stable returns amidst market volatility. Howard Marks highlights specific sectors, such as high yield and private credit, as particularly attractive destinations for investment, underscoring the importance of a diversified portfolio in navigating the evolving market environment. Amidst this backdrop of change, investors find themselves compelled to reassess their portfolio strategies and allocations. While stocks remain formidable vehicles for long-term wealth accumulation, the imperative of diversification assumes heightened importance in mitigating risks and seizing opportunities. Bond exchange-traded funds, ETFs, and high-yield savings accounts emerge as viable alternatives for risk-averse investors seeking to preserve capital in a volatile market environment. As investors navigate this shifting landscape, careful consideration of asset allocation and risk management strategies will be essential in preserving and enhancing wealth amidst the challenges and opportunities presented by the end of easy money. In conclusion, Howard Marks' prognostication may initially stir a sense of foreboding, yet it serves as a clarion call to action rather than a harbinger of despair. While accurately predicting the future remains a challenging endeavor, cultivating a keen awareness of the shifting economic landscape is crucial. Investors who possess the foresight to recalibrate their portfolios in response to the emergence of rising interest rates are positioned to navigate the unpredictable currents of the financial markets successfully. By remaining vigilant and adaptive in the face of changing economic conditions, investors can steer their investment strategies towards long-term prosperity amidst the uncertainties of an evolving financial landscape.